Welcome to Academic Gain Tutorials. In this video, we will look into the differences between financial forecasting and financial modeling. Financial forecasting is an essential function within business planning, budgeting, and operations management. Business leaders, investors, and creditors review these forecasts to assess projected revenues and expenses so they can estimate a company's cash flow throughout the accounting period. A financial forecast considers trends in external and internal historical data and projects those trends in order to provide decision-makers with information about how the financial performance of the company is likely to be at some point in the future. On the other hand, while forecasting provides the base estimates of a company's performance during a given accounting period, modeling allows analysts to use those forecasts to assess how various potential scenarios might impact near and long-term performance. Financial modeling tools let analysts manipulate their forecasts as much as they choose to assess the risk of whatever decisions or investments they are considering. So, let's look into the basic differences between financial forecasting and financial modeling in a tabular form. Difference number 1. Financial forecasting is the process of estimating and preparing for future outcomes, whereas financial modeling focuses on calculating and simulating financial results. Number 2. Financial forecasting aims to predict future revenues and expenses, whereas financial modeling aims to evaluate the financial impact of specific business decisions. Number 3. Financial forecasting is primarily predictive in nature, whereas financial modeling is analytical in nature. Number 4. Financial forecasting uses historical and forward-looking data to make estimates, whereas financial modeling uses forecasts and assumptions to simulate different business scenarios. Number 5. The output of financial forecasting includes projected income, balance sheet, and cash flow statements, whereas financial modeling produces detailed spreadsheet models showing how variables affect financial performance. Number 6. Financial forecasting is mainly used by management and planning teams, whereas financial modeling is used internally by analysts and finance professionals. Number 7. Financial forecasting results are often included in published financial reports, whereas financial models are usually kept internal and not shared with external stakeholders. Number 8. Financial forecasting requires strong analytical and planning skills, whereas financial modeling demands advanced technical expertise in Excel and quantitative analysis. Number 9. Financial forecasting provides a relatively static view of expected outcomes, whereas financial modeling offers dynamic testing by changing variables to see different results. And difference number 10. Financial forecasting helps management determine where the company is headed, whereas financial modeling helps them assess how different strategies can change the company's financial direction. So, these are the differences between financial forecasting and financial modeling. If this lecture was helpful, give it a thumbs up and subscribe to the channel. Thank you.